When you plan, you fail. And when you fail, you fail. I be how did they TikTok and begin? Just plan, sha. By the end of this video, you will have a clear framework for creating a plan tailored to your goals, strategy, and trading style. Subscribe to my channel, people, for more trading tips and strategies, and let's get started. So, what is a trading plan? A trading plan is a mechanical set of rules or guidelines that guides your trading decisions. A trading plan is important because it helps to reduce your emotional decision making, because there are a lot of emotions when you're trading. So this helps you reduce or cut down on the emotional parts. It helps you to stay consistent because you have some rules guiding how you play the game of trading. It helps also with your discipline. So I'm gonna help you create a detailed trading plan. Simple, a simple trading plan. It could be more complex than this, but this is just a basic knowledge of what a trading plan should involve. So let's go to my computer and I'll teach you how to create a trading plan. So yeah, this is how you create a trading plan. These are your outlines, and first of all, you got to define your goals. Why are you trading, and what are you trying to achieve? So I'm just gonna give you where to start from, so you can use it as a yardstick and then you can go from there. Define goals. So this is basically what your short-term goals are. And you would want to make this very realistic as possible, because trading is not a fantasy, right? It will bring you back to reality if you think it is a fantasy. I can just simply put here, so yeah, your goal can be as simple as to make $10 a day, or to make 1% a day, or to make 5% a week. But I'm just gonna go with to make 5% of my initial balance on a weekly. Now, going to the next outline is gonna be, what is my trading style? So your trading style is basically your trading personality. In trading, we have people that are scalpers, swing traders. We have intraday traders, interday traders, day traders, and all that. So for the purpose of this example, I'm just gonna use day trading to intraday trading. It's because sometimes I might hold trades from anywhere between under a day to 3 days. And we have to be as realistic as possible when we are creating this, and don't just put ourselves on high jump. The number three is we have to define what time frames we are going to be using to trade. Personally, I use a lot of time frames, to be honest. I use the daily, I use the 4 hour, I use the weekly, I use the 1 hour, I use the 5 minutes. You have to, state it here, the time frames that you're going to be using when trading. Next is we gotta mention the pairs that we are gonna be trading. Personally, I like to do high volatility pairs to get that movement, the kind of movement that I would like. So I trade gold, GU, I trade US oil, commodities, indices, and all that. This is where you put in the pairs you trade. So after stating the pairs that you trade, you have to be explicit with it, and you shouldn't deviate from your trading plan. Even if you see on the charts where it is written with candles, trade me, you just look away, because you know that that particular pair is not part of your trading plan. So another thing to note is that before creating your trading plan, you always have to backtest these set of information. You have to backtest the time frames you're trading to be able to know that these are the time frames that I should be trading, to put it in your trading plan. You should be able to backtest these certain pairs and know that these pairs are good for what I'm trading and will give me the maximum returns that I'm looking for. The next one is, what sessions am I trading? A pair like GBP USD will be better to trade during the London and the New York session compared to something like a Euro JPY, which is a Japanese yen pair, which is a pair from Japan. So you know that JPY pairs as a whole are better to trade in the Asian sessions. Even if I see my strategy playing out, my pattern, if I see my logic playing out on this session, I would always have to ignore it because my trading plan says so. So the next one is, how many confluences do I require to enter a trade? It depends on what you're trading. If you're trading trend line breakouts mixed with RSIs and MACDs and all that, you say, okay, when the RSI is overbought, when the price is above the EMA, the 100-day moving average, and I see a breakout and this and that and this, how many of those specific things do you need to be able to enter into a trade? That is what your confluences basically are. It can be 3, it could be 4, it could be just 2. So depend on what your strategy is. So for the purpose of this example, I'm gonna say 3. So yeah, now we have gotten to the meat of your trading plan. When a constitution is being drafted, it has to get rid of all loopholes by being explicit about every possible scenario and every possible situation that might arise from trading in this example. I'm just going to give a real quick example. When it comes to your trading strategy, it has to be explicit, could be more detailed than this. In this example, it's gonna be, wait for a range to form on the 4 hour. This is like a range trading strategy, a range breakout strategy. First of all, wait for a range to form on the 4 hour. After that, you wait for a breakout with a candle close out of the range on the 1 hour, then enter after a 5 minutes sweep of liquidity. So if you watch this trading strategy, it's all about waiting. Wait for this, wait for that, wait for this, wait for that. That is what will tell you that trading is a game of patience, perseverance, consistency. You just can't enter into the chart and look for what is not there and expect to make money. No, you have to wait for your strategy to come to you. This is what it is. Just wait. Wait for a range to form on the 4 hour. Wait for a breakout with a candle close out of the range on the 1 hour. Enter at a 5 minute sweep of liquidity. Now these are 3 confluences. Now the next one is your risk management rules. Now when it comes to your risk management, it is just how much or how many percent of your whole balance are you willing to risk on each trade. If you have a $1,000 account, how much of that 1,000 are you willing to risk for one trade? Trading is a game of possibilities and probabilities. It will not be wise to just enter with a large chunk of your balance into one trade, because you could be profitable with a strategy, but you can still have drawdown where you have a losing streak. It doesn't mean your strategy is not working, it just means that you need to take enough chances to be able to come back to profitability. So that is where your risk management comes through. So in this example, I might say 1%. So 1% now of $1,000 account is $10. So if you have a $1,000 account and you're risking only 1%, you would have to lose 100 trades before you can blow that $1,000 account. Or if your trading plan says you have to risk 5%, then you're going to be risking $50 for each trade, meaning that you have to lose 20 consecutive trades to blow that account. That is what it means when you're trading with 5% of your balance. But if you are trading with 10% of your balance, then you are trading with $100 per trade in this $1,000 balance example. But if you have $100,000 account and you are risking 1%, then you are only trading with $1,000 for each trade. And if your risk to reward is about 1 to 4, meaning that you are risking $1,000 to get 4,000. So in this example, we're going to say 1%. So when it comes to your trade management rules, that's the next one, your trade management rules. It basically has to do with how are you gonna manipulate your trade when you are in that trade. How are you gonna take profits? How are you gonna cut your losses? What is your target going to be? That is what trade management rules basically mean, right? So it's just basically saying, okay, if my trade moves, um normally I target 1 to 3. If my trade gives me 1 to 2, I move to break even. That is supposed to be involved in your trade management rules. So, like I said, this is just a simple trading plan. You can make it as complex and as detailed as you want, but don't make it too rigid that you cannot stick to it. Just keep it simple, and and according to what you've back tested. I'm gonna link this Google Doc in my description below if you want to download this document, and just tweak it to what you use or what your strategy is. Just use it as a starting point to construct your own trading plan. The next guideline here is set emotional guidelines. Now, emotional guidelines is just basically what your trading plan says to do when you lose, or when you are fearful of the market, or when you are greedy of the market. So your emotional guidelines could, just say once you lose a trade per day, you leave the market, go do other things till the next day, to avoid revenge trading. It can say once you lose 2 trades in a row, you have to leave till next week. Just what will help you keep your emotions in check. So once I lose 2 trades in a row, I leave the market till the next trading day. Once I lose 2 trading days in a row, I leave the market till next week. So these are some simple emotional guidelines that will keep you in check. Because a trader is not known for when he's making money, but when he's in drawdown, that is when you know your real self. So setting these emotional guidelines will be a way to steer you in the right direction to be able to come out of that drawdown. So another important thing to do is tracking your performance, and you can do this using a trading journal. A trading journal is just basically a software that helps you keep track of your performance and your trades, how you're feeling, what your emotions are. You can basically write it next to any trade you take, if you made any mistakes, if it was an A plus setup, and basically anything that you want to remember. That is what a trading journal helps you to do. And you can use a couple trading journals, you can use TradeZella, and a lot of other ones. So that is what you can do to help you track your performance. So, guys, now you know how to create a trading plan. Now, I'm gonna give you some mistakes to avoid, when it comes to your trading plan. Trading without a trading plan is a very big mistake. Deviating from your trading plan is also a very big mistake. And if you do it, you will learn the hard way. And it will be like, man, I knew I shouldn't have done that. Why did I do that? That was not in my trading plan and all that. So your trading plan helps you to stay grounded.